Ladies and gentlemen, good day and welcome to Nippon Life India Asset Management Limited earnings conference call for 2Q FY23, hosted by InCred Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jignesh Shial from InCred Equities. Thank you, and over to you, sir.
Yeah, thank you, Sanvi, and good evening, everyone. On behalf of InCred Equities, I welcome all to Nippon Life India Asset Management 2Q FY23 earnings conference call. We have along with us Mr. Sandeep Sikka, ED and CEO, along with the top management team of Nippon Life India Asset Management. I would like to hand over to Mr. Sikka for his opening remarks. Over to you, sir.
Thanks, Jimmy. Good evening, everyone, and welcome to our Q2 FY23 earnings conference call. We have with us our Chief Financial Officer, Prateek Jain, Chief Business Officers, Saugata Chatterjee and Ashwin Dugal, Chief Digital Officer, Arpan Saha, and Fujikake-san, representative from Nippon Life. Our detailed investor presentation and press release has been uploaded on the exchanges as well as our website. Before we take your questions, let me share some comments on the recent industry trends and our quarterly performance. In Q2, equity markets rebound from the lows of June 22. However, it ended on a volatile note due to the ongoing geopolitical concerns, global inflation trends, and weaker INR to USD movement. Despite the mixed overall outlook, the Indian asset management industry maintained its growth momentum driven by higher retail awareness. The industry assets rose by 3% in this quarter, mainly driven by higher equity and ETF assets. However, as we look back, the industry assets have seen 4x growth in last 10 years. Yet we believe the significant growth potential still remains unrealized. Currently, less than 3% of the population invests in mutual funds. In the last 24 months alone, the base of unique investors grew to 36 million, an increase of 69%. Monthly SIP flows touched an all-time high of rupees 130 billion, an increase of 67%, while SIP folios increased to 58 million, a rise of 75%. The growth in investor base and consistently higher SIP flows clearly indicate investors' preference for mutual funds to achieve their long-term goals. Formalization of the economy, digitalization, and higher share of mutual funds in household savings are expected to be the key drivers for the growth of industry going forward. At Nippon India Mutual Fund, our priority is to be future ready and capture this long-term opportunity. In Q2, our industry ranking moved to 4th position on quarterly average AUM basis. AUM increased by 7% to 2,851 billion. At Nippon India Mutual Funds, investors' interest remains our only constant. We added 1.6 million folios in H1 and continue to have the largest base in mutual fund industry. Our share of industry's unique investors was stable at 37% with a base of more than 13 million investors. Systematic flows are a stable and a key driver for industry's long-term equity flows. Nippon India Mutual Fund annualized systematic transaction book is at rupees 108 billion. Quarterly flows increased by 36% to rupees 26 billion. On a gross basis, over 481,000 systematic folios were added in Q2. Our systematic AUM rose by 11% to rupees 555 billion. 53% of our SIP AUM has continued for over 5 years, vis-a-vis 22% for the industry. Also, in volatile markets, folios with lower ticket size have demonstrated longer vintage and better stickiness. 14% of our SIP folios have continued for more than 5 years as against an industry average of 10%. Today, Nippon India Mutual Fund offers industry's best suits in passive category also. With strong growth in industry's passive assets, our ETF ecosystem is already in place and far ahead of peers in terms of investor base and mind share. In this segment, we manage an AUM of 638 billion and have a market share of 14%. Excluding the EPFO allocation which goes to two specific AMCs, we would be the largest ETF player in the country. The Gold ETF is the biggest fund in the category with having rupees 66 billion rupees under assets under management. Our share in industry ETF folios rose to 60%. In Q2, we added 108,000 investors and accounted for 92% of the total industry ETF additions. We have 71% share of ETF volumes on NSE and BSE. Our ETF average daily volumes across key funds remain far higher than the rest of the industry. A digital-centric strategy is also one of the keystones of our long-term growth and sustainability. We continue to enable new age and experienced investors as well as our partners with a cutting-edge digital solution. In Q2, digital platforms contribute to 56% of our total new purchase transactions. Over 766,000 purchases were executed through our digital assets, an increase of 4%. Nippon India Mutual Fund has a well-diversified and a nimble distribution base and a wide presence through 275 locations across the country. As on September 22, we have over 87,200 distributors empaneled with us. The MFD base rose to 87,000 with addition of nearly 1,700 distributors in this quarter. Now on the financial performance. For this quarter ended September 30, 2022, profit after tax was rupees 2.1 billion, an increase of 81% against Q1 FY23. Operating profit was at rupees 1.9 billion. Operating profit as a ratio of average assets under management was 26 basis points in Q2 FY23 as compared to 25 basis points in Q1 FY23. In the past, company has followed consistent dividend policy. In FY22, NAM India distributed its highest ever dividend with a payout ratio of 96%. Over the last 8 financial years, NAM India has distributed a cumulative dividend of rupees 34 billion. In today's meeting, board has approved an interim dividend of rupees 4 per share. As we grow organically through physical and non-online channels, we remain open to evaluate investments in strategic opportunities that add to the profitability or complement our existing business and ultimately are in interest of our minority shareholders. As a signatory to UNPRI, we have already begun to integrate ESG aspects into our area of strategy, business operations, investment management and governance. We have chosen to prioritize issues such as climate action, diversity, inclusion, corporate governance, business ethics and responsible investment for immediate strategy formulation, execution and disclosure purpose. Through a combination of responsible investment approaches, of screening, ESG integration and active ownership, we aim to build a resilient portfolio that will not only provide sustainable returns to our investors, but will also provide a positive environment and social impact. To sum up, I would like to reiterate, at NAM India, investor centricity remains a key theme. We strive to deliver a superior experience and sustainable returns to our investors and in the process add value to all our stakeholders. We are confident to continue our trend of profitable growth in coming quarters. With these comments, we are happy to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Thanvi from Banyan Tree Advisors Private Limited. Please go ahead.
Hey, hi. Thanks for the opportunity. So I had two questions. First was on the debt side of the business. So if you look at the entire industry and even for NAM India, debt has been degrowing for last 2 quarters. Wanted to understand, what's happening there. Is it due to performance or is it because shift from active debt to passive debt? What are the factors that are driving the decline in the debt AUM for the industry and NAM India? And secondly, if you see sequentially, our realizations have improved on an overall basis, and that has resulted into improvement in our core operating yields as well. Also, can you throw some light? What are the factors that help us improve the realization? Is it that the competition is easing out, or the distribution margins are softening up, or it is just 1 quarter wherein we saw higher share of equity and the realizations improve? Yeah, these are my 2 questions.
Perfect. I think I'll request my colleague Ashwin Dugal, our Chief Business Officer, to take the first question, and then after that I'll request Prateek to take the second question.
Thanks, Sandeep, and thanks for your question. As to your question regarding the debt flows, that have reduced first at the industry level, and that is quite evident because of the overall deteriorating macros, whereas the central bank action worldwide, and also being followed by the central bank in India, which is to increase interest rates, and the yields across the curve, both at short term and long term, have gone up quite substantially, especially at the shorter end. Hence, we have seen outflows from the debt funds into overnight and liquid schemes. So if you see the trend, you would see that in the last 6 months, debt funds have lost money, but money has come back into either overnight funds or liquid funds. At NAM India, there has been a marginal decline, yes, mainly because our growth over the last 2 years was on the back of fixed income flows and partially from some corporates, and we have seen 1 or 2 institutional investors who exited for the time being, who had a higher share with us. And from the industry as well, we had a slightly higher share, hence we've seen some dip in a share for us.
Realization, Prateek, you want to take that one?
Yeah. Hi, Kunal. So in terms of realization, there are mixed factors, so it is not one-off. I think we have been maintaining that, look, it would be hovering around, these levels, unless there is a drastic change in the, the asset mix. Here, I think 2 or 3 things played out for the quarter. One, we have actually, we had a better share of equity. That was one. Secondly, in terms of, flows and in terms of our fixed income realization, there has been a marginally increase out there. We've been, we have mentioned in the past as well, as the yield keeps growing in the fixed income scheme. Dissect this from the fact that the assets are going out, but more importantly, yields in these fixed income schemes are going up. As the yields goes up, in these categories, our propensity to charge slightly higher improves, and so we have rationalized some of our TERs into the debt schemes, and we have been able to improve our realization out there. Besides, on the ETF side, we have seen slight improvement in the realization, marginally due to some regulatory interventions, of requiring only 1 basis point to be kept aside, for the investor education. So these are the couple of factors, which are, I would say, these are not one-off, but these are sustainable ones, which has helped us in this quarter to improve our realization.
Sure, got it. And historically, we have been suggesting that over the medium to long term, the realization could keep on tapering off because of the new assets coming in. That continues to be the case, right?
That's right. So as and when, we'll see, as the old asset kitty versus the new asset, the change happens, then obviously you will see some decline. But as I mentioned, in this call, that look, as you see money coming into the fixed income, assets, and the realization at the elevated level as what we are seeing right now, our propensity to charge higher, and also when the cycle will turn, when you will see, returns which is in the range, 8.5 to 9%, at that point of time, our propensity to charge will be even higher. So we'll have the AUMs in place because money would have moved into these categories, which has gone out now, and also the yields will be higher, and therefore you will get the double impact, and I'm sure that will be able to offset, the realization dip in the equity assets.
Sure, got it. Now, just one more question if I can squeeze in. So if you look at our asset mix and our market share mix, so over, last 2 to 3 years, what we've seen is that we, like on an overall basis, the market share is quite stable now, like between 7.2% to 7.4%. But within that, say segments like equity and debt has not gained market share or have been, losing market share. For example, in debt, we gained some market share last year and now we are again losing it back. But two segments where we've been gaining market share are liquid and others. Like that's where, we've gained market share and we continue to gain that. But now from a, overall profitability business point of view, these are low yielding assets. Now, how do we look at this, from a longer term perspective? Because this will mean increasing market share in the categories which are, lower yielding would result into, of course, lower profitability for us.
Well, the way I see it is, I think I would not have to read too much into the fixed income. I think that's more because of the overall environment. We have seen investors, changing to shorter end of the curve, and this will keep happening. So I don't see any law because I think this is all fungible. I think liquid, short term, long term. So what investors will keep changing across different cycles. So I'm not too worried about that. I think as far as the equity is concerned, clearly I think from our perspective the green shoots are already there. Yes, I think as you're aware, we had a certain challenge in equity a couple of years back. At this point of time, the majority of our funds, if you were to see, on 1 year perspective are in quartile 1 or quartile 2, and I think we are just almost in some of our funds are already a 3 year basis also, rolling basis are moving to the quartile 1. And the fact that the increase in SIP numbers, folios tells you that I think the new investors and the flows have already started coming into equity. So maybe a couple of quarters down the line, I think you will start also seeing the lag effect of this positive, the activity that is happening on ground, and the equity market share also should move up.
Sure. Thank you. I'll get back in with you. All the best.
Thank you. The next question is from the line of Lalit Dev from Equirus Securities. Please go ahead.
Yeah. Good evening, sir. Thank you for the opportunity. So, sir, my question was on the distribution side. So, if we see the banking channel, about 1 year ago, the share of AUM which was coming through the bank channel was about 10%. However, it has declined to about 8.5, 8.7% in this quarter. Now, with majority of our schemes now performing back to Q1 or quarter 1 and quarter 2. So what is the outlook over there, and how is the response are we getting from the banking channel?
So, from our perspective, banks any which way for us were about 9% in overall scheme of things, and if I take the direct out, it was about 18-20%. So from our perspective, even if that decline, it doesn't really means much for us. However, I would ask Chatty, to talk about how he sees flows going forward.
So, in case of the banking channel, what was our handicap earlier were the approvals. Like you did mention now, since the equity performance has come back, good part is that in most of the channels and the banks, we have the approvals in place. The approvals are now getting converted into business volume for us on the equity side. We have a bit of catch up on the debt side in the debt side in some of the banks, But most of the banks, if you see, are either equity players or SIP players, where the approvals which have come in the last 2 or 3 quarters are going to help us. We have now majority of our funds are approved in most of the retail and in the wealth banks. The numbers will start reflecting as we go ahead because equity comes with a lag. SIP numbers have started coming in. The net sales is improving. Hopefully, these ratios will start improving in the next 2 quarters from here on.
Sure. Yes, that is the only question. Yeah, thank you, sir.
Thank you. The next question is from the line of Dhwanil Shah from Motilal Oswal Financial Services. Please go ahead.
Hi, this is Prayesh Jain. Just 3 questions. Firstly, if you look at how the redemptions have shaped up on the equity side for the industry, those have been kind of increasing in the last couple of months. Any early trends to be catched there as to there is some profit taking or some issues out there where there are increased redemptions? Secondly, on the fee and commission expenses, we've seen an increase. What is that pertaining to? And thirdly, from an other income perspective, do you think that the current trend rate that what you have achieved in this quarter, given if the yields remain where they are and possibly even the equity markets kind of see steady returns, do you see these kind of other income sustainable? Those will be my 3 questions.
If you could take the second and the third, fee realization and others, then I'll take the redemption.
Yeah, so I mentioned in the past that this fees and commission expenses are pertaining to our AIF and PMS businesses. So in AIF still we have we pay upfront commissions. So that's where if you get a larger amount of asset raised in the quarter, you'll see some marginal increase out there in terms of fees. But obviously the corresponding revenue will come with a lag effect. So that is the expenses in the fee and commission side of it. In terms of realization, as I mentioned that look, this is these are more sustainable at this point of time. If we see the interest rate peaking up from here, then a lot of money will come into the fixed income category. All the money which has gone out will come back to the fixed income category from the corporates and institutional investors. And then they will ride on to the fact that, look, when there is a interest rates goes down as part of the cycle, then there will be and higher yields will be made into these products. And when there are higher yields, our propensity to charge will be higher. So if you see overall on the fixed income side, 2 things have happened. One, if you see last 2.5 years, a lot of money has gone out from the the longer duration and credit funds and come into the shorter end of the curve and into liquid and other money market fund. And the second part is that look, in these funds also the returns were fairly low. They were sub 5.5%, and therefore our propensity was to charge expenses were lower. But our average yield on these products are likely to go up in the coming quarters.
So, Prateek, just my question was more on the other income that we've reported in this quarter, whether that is sustainable given the way the yields are moving and the equity markets return.
Oh, so see, these are all mark to market and as shared in the past, total investment, total cash flow available, 82% of those assets have been invested into our own scheme, into mutual funds. And of that, barring the seed capital investment which we made into equity, remaining are into our fixed income schemes only across the categories. And so obviously as the yields goes up, our realization will increase from here on. But we do not give any kind of forward guidance on our other income. But there are no major assets which are into the risk categories at this point of time, which I can tell you.
As far as the redemptions are concerned, if you were to look at the net equity flows, I think in the industry X of arbitrage for the 4 quarters have been 28,000, 20,000, 23,000. I think it's broadly been the same range. Yes, I think from our perspective, I think one thing is very critical is I think now is there any early trend of redemptions? Clearly, whenever the markets are volatile, it's the HNI investors, the bulk money which goes out, moves out fast and comes in. The movement is faster. That's exactly the reason we try to we focus more on granular business, retail business and SIPs, which is a lot more sticky. So I think from our perspective, I think we have not trying to, not witnessed any kind of redemption at this point of time. And I think for us, I think the trend could be a little different from the industry because our business is very, very retail.
Just one more question there on from a flow perspective, while you all don't give any data as such, what flows, is there a trend of increasing flow market share for Nippon India on the equity side in the last, say, couple of quarters? Can you at least give that indication?
I think from over many last quarters, I think we have seen the trend getting positive. I think if I was to look over a trend line over last 36 months, from net negative to we have moved to net positive.
But the market share has obviously been going up. But is it there in line with the overall equity market share, or is it lower than that?
So the net sales market share is inching up towards the equity market share. So that is the reason why you'll find month on month our equity market share is also now improving.
All right. Thank you so much.
Thank you. Ladies and gentlemen, if you wish to ask any questions, please enter star and 1. Participants, to ask a question at this moment, you may enter star and 1. Next question is from the line of Manjeet Buaria from Solidarity Investment. Please go ahead.
Thank you for taking my question. I wanted to understand, as the competitive intensity in the industry goes up and different players may have to pay more commissions to the distribution partners, as we have seen in some NFOs, how easy is it to claw back these commission levels? Or once the higher levels are given, it stays that way permanently?
I think from our perspective, the way we see, we have always been very clear that long-term business models cannot be paid, can be made by paying higher brokerages. So we've been pretty conscious on it. I think whatever is sustainable, we would not like to do something which is not sustainable from a long-term point of view. So I think from our perspective, I think we have never gone overboard, and wherein we will have to undo things later.
Okay, thank you.
Thank you. The next question is from the line of Aditya Dilip from Metaverse Equity Fund. Please go ahead.
Thank you, ma'am. My question is, NAM is collaborated with DWS Group to provide portfolio management and advisory services in European market for Indian government bond ETF. So as far as the current situation is concerned, the recession part. So what would be the upcoming plan from Nippon? And as Indian business is showing the stable growth as compared to the European market. So that is my question.
So I think our launch of product in with DWS is aligned with our strategy to grow our non-mutual fund business and offshore business. As we have mentioned in past, I think we closely work with Nippon Life team globally to look at opportunities where we can collaborate with the various group companies of Nippon Life. There are many more such initiatives where work is in progress. This fund was launched just about a month back. I think at this point of time it is just started, and I think we clearly see, there will be a couple of other products which will be launched across the globe, but the focus will remain to get more money into India.
Okay, thank you, sir.
Thank you. The next question is from the line of Vanil Shah from Motilal Oswal. Please go ahead.
Yeah, hi, this is Prayesh here again. Just thoughts on on the hybrid segment. The industry has seen a lot of outflows in the past few months, and is there any peculiar reason for that? Why that has
Yeah. So
Saugata this side, the hybrid section, hybrid category, prior to the volatility in the market, there was more flows coming into the the large cap, mid cap, those categories. Like you are rightly saying, last 6 months we have started seeing more flows in the hybrids. More so, it is more as the volatility increases, the trend shifts towards balanced funds, hybrid funds. So we are seeing that trend happening today. I think if the volatility continues for the next 6 to 12 months, this category will start growing, and that should be a good thing for the industry because these are stable long-term assets which come in balanced funds.
Okay. So my question was, they were actually witnessing outflows, not inflows.
No, outflows in hybrids are not happening this time. In the last 3 months, 4 months, rather the net sales is positive. It can be due to some NFO which has come in, which might lead to outflow in certain particular part of the quarter. But the trend is still positive. You have to add a hybrid category. It includes equity hybrid funds. It includes balanced advantage funds. It includes asset allocation funds. So the category is very large. It's not only one particular category which comes under hybrids.
And what are the plans for future launches with regards to all the scheme categories?
I think from our perspective, I think we broadly feel our portfolio is complete. I think we will not be launching any funds just to come out with new NFOs. I think where you'll see more launches will be, I think whether it could be some thematic, international or passive.
All right. Thank you so much.
Thank you. The next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Hi. Good evening, everyone. Sir, sorry for this.
Sorry to interrupt, sir. Can you please speak a little bit louder? Your voice is very...
Is it better now?
Yeah, better now.
Hi. Good evening, everyone. Sorry for this. Sir, so my 3 questions are, there's some improvement in the equity yields, right? So is this something structural? Are these yields, is this the improvement structural in nature, and is this sustainable? Second was around, there's some dip in the staff cost, right? So any color on this? And thirdly was on the on your channel mix, right? So there's some sharp dip in the share of banks. If you could throw some color out there as well. I'm sorry if you have already answered these questions. I joined the call a bit late.
No issues. In terms of yields, the overall yields, is slightly marginally up as compared to the previous quarter. And as I explained in the past, that this is predominantly because we have improved our realization on the fixed income schemes, and I've given a detailed explanation for that. And also our asset mix has marginally improved in terms of overall longer term high yielding assets, and these are pretty sustainable and not one off. Also as Sandeep was mentioning, that look, we'll keep working in terms of our product offering, the distribution commission, which are sustainable and will not go overboard in terms of extending higher distribution commission for for a faster growth. So that is one. In terms of staff cost, this is marginally lower, and these are related to certain provisions, etc. And there is no structural thing which I can see up in here. And with regards to the channel mix, again, if I see the last few quarters, it used to be in terms of overall share, including the direct, etc. It used to contribute about 10%, and now they are 9%. So again, there I see a very marginally decline there, and that is because banks, if you see overall from an industry perspective also, the bank share has come down.
So there's just like to add to what Prateek mentioned, is the fact that in the last few months we've seen some bit of institutional money that some wealth counters, etc. had been mobilized. Some of that has moved out at the industry level, But the SIP business and the long-term sticky money continues to come in.
All right. And one thing was, so I mean, on the staff cost, what did you just say? I mean, there's this dip sequentially. So, is there some reversal in this line item?
Sorry?
Is there some reversal in the staff cost?
No. See, like in the first quarter, there were certain, incentives, etc., which got PLI, got paid out. And if you see the standalone results, there is nothing, but it is to do with our subsidiaries. So, certain PLI expenses which got booked into the first quarter, and therefore there is a marginally, I would say, staff cost has declined.
Right. And in terms of your yields on the debt, so the yields on the debt in the debt schemes have improved, right? So is there a change in the mix towards the credit risk funds or those sorts?
No. Again, I am telling you, see, what you have to understand is that, look, while assets may change, what we have done is we have gone and improved our realization by changing TR, so which we dynamically keep evaluating. What is the return which an investor or what is the return which fund is generating, and based on that and what is the expenses what competition is charging, what is vis-a-vis our performance vis-a-vis competition. Based on all these factors, we keep evaluating what is the expense we should charge on our debt schemes, and there what we have done is we have changed realization in some of our schemes which have resulted in a better realization. Now, this is not to be seen that, look, in these categories, monies have come in and all that. These are completely, these are two different strategies. So while money may, but overall yields have gone up because of the underlying returns generated by the papers. And therefore, we've been able to increase our expenses.
And any color on the yields, how they are shaping up on the equity side?
So again, we have not seen, significant change out there. Our sharing remains pretty much the same as what we were paying earlier. And obviously, as I mentioned, that look, the more and more new money replaces the old assets, then obviously we'll see, some decline. So over a period of time, we may see 2 to 3 basis points of decline, if this money gets replaced by the new assets.
Okay, but the trend is still, I mean, the equity yields are still depleting. That's a correct understanding, right?
So on the existing AUM, it will not, but if the new AUM comes, and the old asset kitty keeps going down, then obviously you will see some decline in the equity yields.
And for us in Q2, I mean, given that the flows in the equity schemes for the industry were a bit soft, so for us, how have the flows been? Did we witness net outflows or net inflows in?
No, we were net positive in terms of inflows, and this was broadly in the range of our quarter one only.
And any color on the market share in terms of net flows?
We don't disclose those numbers.
Okay. Those will be my questions. Thank you.
Thank you. The next question is from the line of Dipanjan Ghosh from Citicorp. Please go ahead.
Hi, good evening. Just 3 questions from my side. One, just continuing the previous discussion. Would you like to quantify the differential between your existing and new business from the equity segment? My second question would be on the SIP business. If you can give some color on what is the key distribution channel or origination channel for the SIP. Is it more direct or fintech-led or through the distributors? And third question, from an industry perspective, what we have witnessed is that there have been significant amount of flows that is going into the NFOs of schemes where the incumbents are already present, but probably are not able to garner flows which are similar to that of the newer NFOs that is coming in. So how do you see this particular, how do you want to kind of see this from medium-term perspective, given that a lot of new AMCs are also in the pipeline? That will be all from my side.
Dipanjan, if you can just repeat your first question.
My first question was if you can, in the previous discussion you mentioned that, the new yields continue to be lower than the existing yields on the equity business. So would you like to kind of quantify what is the differential out there?
Yeah. So, in the past, we have, again, on the cost of repeating, see, on the old assets, our average, distribution commission paid, was, 50 to 60 basis point. However, if you see now, it is more on a TR sharing basis. So obviously, for different distributors, we share different amount of fees. So, and it ranges between 55 to 70% of our TR we share, or DTR, we share with our distributor. So that is the difference, because in the past, old assets, we have paid higher upfront commission, and which are no longer allowed, and therefore it is entirely on trail, and therefore the sharing mechanism has come in, and we share almost 55 to 70% to our various categories of distributors.
Yeah. So on the other question on SIP mix, yeah. So the mix of business, as we see in the last, say, 2 to 3 quarters, the digital and the fintech partners have started contributing, decent to our overall mix. Right now, as we speak, 60% of the business is coming from MFDs, which are primarily IFA for us, and some of the banking channel partners have started giving us money. They are giving us tips, and the remaining around 35 to 40% is coming through the fintech partners. So that is broadly the mix of SIP numbers which are coming to us. And what are we witnessing is we are also increasing the absolute count on a month-on-month basis. So right from a ratio point of view and as well as absolute numbers, both are seeing a growth. Both the categories are growing for us when you consider SIPs. The third question was on NFO, right? You asked something on the NFO.
Yes.
What was that? If you can repeat.
Basically, from an industry perspective, what we see is that let's say the incumbents have particular schemes in, let's say, mid cap, large cap, flexi cap, but then you see schemes NFOs coming in from the smaller players in similar categories, where the flows are probably a bit higher than even the combined of what the incumbents are garnering in those schemes in particular months or quarters. So from that standpoint, given that a lot of newer AMCs have loopholes in terms of schemes that they can introduce, or there are also new AMCs in the pipeline. So how would you kind of think of opportunity loss with kind of new flows in existing schemes for larger players like yourself?
I think broadly the way I see this is something this side. Any new or old AMC, I think any new fund launched, until the time it adds value to the portfolio in the long run, investors will keep investing. I think any new NFO becoming, whether there is higher brokerage or capability to pay, from a long-term point of view, that is not sustainable. Ultimately, these are all open-ended schemes. One can garner X assets, through an NFO. But for these assets to be sticky, A is to add value to the investor from a performance point of view, and the B and the more important thing is it has to be very, very granular and sticky, because we have seen when this bulk money comes, it goes out also at the same speed. So I think from our perspective, our focus is not to get distracted with the new NFOs which are coming in the industry. I think, and we'll continue focusing on our existing schemes, and wherever we see any vacuum for us to, or an opportunity for us to launch new products which can add value to the investors, we'll do that. Otherwise, I think our focus will be only on the open-ended existing schemes.
Okay, sure, thanks. Just a small follow-up on the second answer. You mentioned that almost 35 to 40% of SIPs are coming into the digital or fintech-backed channels. Could you shed some color on the quality of customers in terms of retention or average tenure, or in terms of redemption from the SIP or ticket size? If you can, or maybe more from a geography or age perspective, if you can shed some color on that particular portion of the SIP business that is coming in.
I think it will be very difficult to give these kind of details, but I think we continue evolving. I think we continue to evaluate. I think whether it's coming from an offline channel, even if coming from distributors, IFAs, or whether banking or fintech, we continue to evaluate, I think, the stickiness of the assets, I think which distributors, which channel we need to promote more, I think, and again from a geography point of view, but again, it will be very difficult to pinpoint how a particular pocket, whether geographically or channel-wise it works. But I think our endeavor is, I think as we mentioned earlier, I think the sticky assets are 50% of our, I think that as I mentioned in my opening address also, today I think if you look at the stickiness of the SIPs that we have, today the majority of our SIPs, 53% of our SIPs are there for more than 5 years. So I mean that is I think our focus. I think, and we are using a lot of artificial intelligence and business analytics to continue both to upsell as well as continue to increase the longevity of the SIPs.
Great. Thanks for the answers and all the best.
Thank you.
Thank you. The next question is from the line of Rahul Pecha from Multi-Act. Please go ahead.
Yeah, thanks for the opportunity. Sir, just wanted a couple of data points. What is your current blended yield on your equity book, and what is the yield on the new flows that you are getting?
So we don't give product-wise yields, on this one. And what was your second question?
No, the second question was I wanted the yield on the new flows. But if you can't give specific yields, even if you can, give out the differential between your current book and the new yields, that will also be fine.
No, I just explained to you that, look, on the old assets, the average distribution commission paid out would be in the range of 50 to 60 basis point, and, on the new money which we are receiving, post the change in the regulation, what we said that, look, we share almost 55% to 70%, on average, of our TERs to various distributors, in different categories.
Okay, and this 55 to 70%, in terms of basis point, how much would that be?
No, so each different scheme has a different TER. So nowadays, from a SEBI perspective, there is a calculation of TER. Suppose that we remove the scheme-related expenses to arrive at distributable TER. Of the distributable TER, we share this money.
Okay. Okay, fine.
Thank you. That was the last question for today. On behalf of InCred Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.